Welcome to part 2 of the latest podcast from the Gold Chronicles with Jim Rickards and Alex Stanzik, presented by Physical Gold Fund.
Let me stay on a subject that's clearly relevant to the future fate of gold, and we mentioned it briefly. Jim, you've been previewing your new book recently, The Road to Ruin. And in it, it's clear that you develop a theme that you actually wrote about in The New Case for Gold, and that is the coming ascendancy of the IMF's own currency, the SDR. Now, we've talked about this, of course, on this podcast several times, but my question is, in a world where the SDR begins to displace the dollar's dominance, what happens to gold?
Well, it's a great question, John, and you're right. Thank you for mentioning the book. But for the benefit of listeners, I do have a new book. It will hit the bookshelves, the bookstores rather, November 15th. It's called The Road to Ruin: The Global Elite's Secret Plan for the Next Financial Crisis. It's available for pre-order on Amazon now. So, and it's actually it's number one on the charts. Amazon has all these subcategories, and they have one for money and monetary policy. And the book is still about a month away from shipping, and it's already number one, so it's doing very well. Thank you. Yes, but I do talk quite a bit about the future of the international monetary system and the role of SDRs. Now, I think a lot of our listeners have pretty good familiarity, partly because of the work we've done on this podcast on SDRs. But just for those who might not be quite as familiar, I'll just give a brief overview. SDR stands for Special Drawing Right. A little bit of a technical name, but it's just world money. I'm sure the people who created it didn't want to call it world money because that's a little spooky, but it is world money, and it's not complicated. The Federal Reserve can print dollars out of thin air. The European Central Bank can print euros out of thin air, and the International Monetary Fund can print SDRs out of thin air. They can act like the central bank of the world, create these SDRs, hand them out to the members, and they count as reserves, and all the members of the IMF, it's 189 countries around the world, are bound by the Articles of Agreement to accept SDRs the same way you would accept dollars or euros or yen or gold for that matter, or any other reserve currency. So it's a way to create global reserves out of thin air. Now, why am I talking about this, and why am I predicting a much bigger role for the SDR sooner rather than later? The answer is it has been 8 years since the last financial crisis, 9 if you want to go back to the start of it in 2007, a little over 8 years if you want to go to the most acute phase in 2008. But it was 8 years ago. But the history of financial crises and panics over the last 30 years is that they happen every 7 or 8 years. We had a one-day collapse, October 19th, 1987. The stock market dropped over 20% in one day. Not a week or a month, but one day. That would be the equivalent of a 4,000-point drop in the Dow Jones Industrial Average today. And that was, as I say, October 1987, 1994, the tequila crisis, 1998, the Russia long-term capital management crisis, 2000, the dot-com meltdown, 2007, the mortgage crisis, 2008, Lehman, AIG. I don't have to go through all of them. The point is that these things happen every 7 or 8 years, almost, if not quite, like clockwork. Well, it's been 8 years since the last one. How long do you think we're going to go before the next one hits? And the answer is it could happen tomorrow. It could happen any day. In fact, if I've done some research, and without taking sides in politics, I expect if Trump wins on November 8th, you might expect an immediate 10% drop in the stock market. You might see the Dow Jones go down over 1,000 points in one day, just like that, because they're priced for a Clinton victory. And if Clinton wins, then kind of nothing happens. It doesn't mean the stock market's going to go up 1,000 points. They're already priced for her victory, but they're not priced for a Trump victory, and there would be this immediate repricing. And that could be enough to start really an avalanche of selling and contagion around the world. And so this is something that could happen any time. But certainly in the next couple of years, it is highly likely. Now, what happened the last couple of times? We had crisis. Well, in 1998, Wall Street got together and bailed out a hedge fund. In 2008, the central banks got together and bailed out Wall Street. Well, the next time, who's going to bail out the central banks? In other words, at the beginning of the crisis in 2008, the Federal Reserve balance sheet was about $800 billion. Today, it's closer to $4 trillion. They printed over $3.2 trillion to bail out the system the last time, and a lot else beside. I mean, they guaranteed every money market fund, they guaranteed every bank deposit, they did trillions of dollars of swaps with Europe, massive liquidity injection by the Federal Reserve and other central banks. If somehow the Fed had managed to get its balance sheet back to $800 billion, and in other words, they created all this money to solve the problem, and then they made the money go away and normalized their balance sheet, I'd be the first one to say, hey guys, great, and ladies, great job. You saved the system, you got back to normal, nice going. But that didn't happen. The $4 trillion is still on the balance sheet. So what are they going to do in the next crisis? Are they going to print another $4 trillion, take their balance sheet to $8 trillion? Legally they could, they might, but in my view, they're going to be highly constrained. In other words, they're going to push against an invisible confidence boundary. They're going to lose the confidence of and this is true of central banks around the world, not just the Fed. They're going to lose the confidence of their people, the people who rely on the currency, their national governments, policymakers, et cetera. They're not going to be able to do what they did the last time. So where's the money going to come from? If you have a liquidity crisis, which I expect sooner than later, and you need a liquidity injection, and it cannot come from central banks because they're tapped out, their balance sheets are stretched, where will the money come from? The answer is it will come from the IMF in the form of these SDRs, because the IMF balance sheet is not stretched. They're only leveraged about 3 to 1. Our friends at the Fed are leveraged over 100 to 1. I mean, not even a comparison there. So they'll print these SDRs and hand them out. Now, your question specifically is, where does this leave gold? Gold wins one of two ways. I think either way gold wins, but let me be specific about that claim. The first way is that the SDR thing works, that, people, if they really understood it, they might have objections, but the truth is nobody understands SDRs except a few PhDs and the people on this podcast. But you can see if you print 2 or 3 or 4 trillion SDRs and give them to all the countries around the world as part of the reserves, that's going to be highly inflationary because that money is going to get spent. A lot of the money the Fed printed did not get spent. It just got handed to the banks, and the banks put it back to the Fed in the form of excess reserves. But the SDR money that goes into reserves is going to be spent by the governments. They'll be desperate to resort to fiscal policy, so-called helicopter money, massive government spending. The basic theory of Keynesianism is if people won't spend, the government will. So right now we're in a liquidity trap. People don't want to spend. They want to save, pay off debt, put the money away for a rainy day. There's debt and deleveraging. So the money's not getting used. But governments are very good at spending money, as we know, and in the next crisis they will. They'll recognize that you can't have a pure monetary solution. You have to have a fiscal structural solution that will involve government spending. We're already hearing about this from both candidates, Clinton and Trump. So the SDR prints up 5 trillion SDRs. That's worth about $7.5 trillion, by the way. One SDR is worth a little bit less than $1.50. So somewhere between $7 trillion and $7.5 trillion. Handed out, governments will absolutely spend it because that'll be their job. And all that spending and money printing will be inflationary. So gold will go up for the reasons gold always goes up in inflation, which is, you're cheapening the dollar. That means a higher dollar price for gold. Gold is the ultimate inflation hedge, always has been. But let's imagine another scenario. Let's say that the SDR rescue doesn't work, that there's a massive loss of confidence in paper money. People say, you know what, well, we lost confidence in the dollar, the euro. You want us to accept these SDRs. We're not accepting those either. It's just another fiat money bailout. It's just more money printing by a different name. I'm out of here. I don't trust any government money. I don't trust any fiat currency. Give me hard assets. Give me land, gold, silver, fine art, jewels, whatever it might be, water, energy, etc. But I want to get out of the money system. I've lost confidence. Well, where do people go? They go straight to gold. Now, you could go to silver and art and some of the other things I mentioned, but a lot of that demand will go to gold. So if SDRs work, it's inflationary and gold goes up. If SDRs fail, it's a destruction of confidence and gold goes up because it's the only thing people will have confidence in. So they are different paths, but they end up in the same place, which is a much higher dollar price for gold. Now, just to be clear, $10,000 gold doesn't mean that you made 5 times your money in real terms. You might just be breaking even, but at least you are breaking even. In other words, you're preserving wealth because $10,000 gold doesn't mean that gold went up 5 times. It means the dollar went down 80%. But I'd much rather have gold than dollars. I mean, that's the point. That's why you have gold, to preserve wealth. It's not a bonanza, but at least you're the person who is preserving wealth and is as rich as you used to be, or have your savings intact when everyone else around you is getting wiped out. So I think that if the STR rescue works, it's inflationary, gold goes up. If it fails, there's a loss of confidence and gold goes up because it's the only thing people will have confidence in. I think of it as a horse race, John. Maybe, picture the Kentucky Derby. You've got 10 horses lined up in the paddock, and the horses are named, dollar, euro, yen, yuan, sterling, gold, SDRs. These are all the forms of money. And the gate opens and they're off, and they're coming around the track. But one by one, the horses stumble or drop out. And at the end of the finish line, there are only 2 horses left, gold and SDRs, and I think gold wins the race.
Well, thanks, Jim. Alex, I know you have many questions from our listeners. And listeners, by the way, if you haven't done so, let me encourage you to add your question now. We'll try to get to it if we can. But first, Alex, I wonder, before you turn to our listeners, I wonder how Jim's predictions here appear to you as a key player in the physical gold market.
Well, I have learned over the years that Jim's forecasts are correct far more often than they're not correct. So I personally don't tend to second guess Jim too much. As you've mentioned before, Jim is an advisor to our gold fund. We take what he has to say very seriously. Almost everything he's projected in his books, from currency wars to the death of money, the new case for gold, have either already come true or there are events that are unfolding that would suggest that they are on track to come true. In regards to gold, one thing that's good to keep in mind is that gold serves different roles when it comes to central banks and monetary policy than it does for individuals and institutional investors. For central banks of countries besides the United States, gold is a way to hedge the US dollar, but gold is also the last line of defense for liquidity and confidence backing central bank issued currency. So in other words, gold's purpose in the central bank balance sheet is different than it is for an individual investor. As far as individuals go, our view is that gold's role moving forward is that of insurance versus tail risks and systemic events that could cause lockups, so to speak, in liquidity or perhaps another global financial crisis. People need to be thinking of gold in terms of what is least likely to be impacted if the engines of finance are grinding to a halt. And it's interesting, this discussion has been about the IMF and the SDR because it's the IMF that said about gold in one of its reports that gold is the only asset you can buy that essentially does not have counterparty risk. And that's even up and above SDRs. So, based upon our experience so far in 2016, this is exactly what's been happening. People who have never had an interest in gold or been an investor in gold are starting to take a really hard look. Just for example, just over the last 48 hours or so, I've talked to potential investors who are representing millions and millions of dollars of investment. They've never invested in gold before, and they're starting to take a hard look. And I keep hearing this recurring theme in their language, and that is protect purchasing power. I've heard that at least 4 times in the last 48 hours. This is a really important sort of sea change in the gold markets, because in the time that I've been in this industry, which is almost a decade now, mostly the people who have been involved in precious metals are what many would refer to as gold bugs. These are people who way ahead of the curve were interested in gold and were investing in gold. The truth is that a very small percentage of wealth is allocated into precious metals, something like 1.5%. And I have always been a believer that as soon as the other 99% or 98.5% start taking a serious look at gold, then we're looking at some major changes. So this is a very important change to me. With that said, we have some time left. I think we've got about 20 minutes. We have a number of different questions that are in the queue here, Jim, and these are all directed at you. The first one is, what effect does $4 trillion worth of gold traded per day in the FX markets have on gold price? And another question about that is it used to control the price or maybe manipulate the price? This is coming from Ross M.
Right. Well, the volume of trading by itself isn't the determinant of price. Obviously, it's the bid offer or the direction of trading or where the market price clears. But the number is important because what it shows, and I've always found this to be true myself, is that the liquidity in the gold market is very good. Gold is a funny market. Most markets, when the volume isn't very much, the liquidity is not good, and vice versa. But gold is a market even when volumes are low, liquidity is good, meaning you can always buy and you can always sell. Now, you can't always guarantee a price, of course, but I've never seen a situation where gold went no bid. I have seen situations where nobody wanted to buy a particular stock or a particular bond or real estate or condos or whatever it is until the price went a lot lower and the market's clear. But gold does move more like the way economists imagine markets to move, which is there's always a bid kind of at every level, even if it's trending down or trending up. Now, the question is there manipulation of the gold market? The answer is absolutely yes. It doesn't mean there's manipulation all the time. It doesn't mean that every price move is manipulated. As I explained earlier in the call, the drop, the air pocket, as I call it, from about 1360 an ounce to 1250 an ounce, that was, I don't view that as manipulated. That was a fairly rational repricing in reaction to a higher expectation of a Fed rate hike, although I also explained why I think the Fed rate hike will be self-defeating and lead to dovishness because they're tightening at the wrong time for the wrong reasons, and gold will come back up again. But I don't view that as a manipulation. So the short answer is there is statistical and empirical and other evidence that shows manipulation. I've spoken to the experts. I've been involved in various ways with some of these class action lawsuits. I've spoken to the plaintiffs' experts. I've spoken to PhD statisticians who have done very long, 10-year and longer studies of this. The manipulation is very clear, but it doesn't mean that it's manipulated all the time. It doesn't mean that every move is manipulated. And as I say, the most recent one, I think is not that difficult to explain based on market forces. So the other observation I would make is that yeah, there's manipulation, but manipulation always fails in the end. It can succeed in the short run, often does succeed in the short run, but it always fails in the end, and you just have to look at two classic cases. The collapse of the gold pool of the 1960s, that was a group of, really at the time, the G7 countries that were trying to prop up the price of gold, and they agreed to pool their gold resources and be sellers if the price high and be buyers if the price got too low. And what they ended up doing, they ended up just selling all their gold in order to support the price, and it was becoming untenable. And basically, it collapsed. They were trying to keep the price at $35 an ounce, and the market was demanding more and more gold, and they kept selling it to try to keep a lid on the price, and it didn't work. It failed. And then there was gold manipulation in the late 1970s. The United States and the IMF, operating really hand in glove, dumped 1,700 tons of gold on the market. That's a lot of gold. That failed also. The price shot up to $800 an ounce in January of 1980 when that manipulation was over. And the manipulation going on today will fail. So they always fail in the end. It's painful if you're on the wrong side of it, but in the long run, you will be vindicated. I did see one comment, Alex, I just want to add to this comment, which is someone was asking, well, if you think the Fed's going to raise rates in December, but then go dovish after that, should I, perhaps sell my gold position right now and buy back in at a lower price in December? And the answer is, not only is the answer no, but that's not what I was saying. I think gold will go sideways. I didn't say that gold was between now and December. I mean, look, anything can happen. I'm not completely ruling that out. But I don't have a scenario where gold goes down until December and then goes up again. I have a scenario where it goes sideways and then goes up after that, probably late this year, early next year. So I wouldn't sell into this. As I say, if anything, it's a good entry point to buy and add to your position.
Okay, I agree with that. I think this is as far as entry points are concerned, this is, in my mind, sort of a gift. Okay, the next question is coming from one of our international listeners. We have quite a few listeners that dial in from around the world. Some of these folks are managing money professionally. This is coming from HBK Bangalore, and the question is, will the dollar weaken against other currencies? What are your thoughts on that if Trump were to win the election?
Boy, that's a tough one, mainly because Trump's such a wild card. I mean, you never quite know what he's going to say next. I believe the dollar would weaken because Trump's a bit of a mercantilist. It's sort of an 18th century school of international economics, but he says, be an exporter, don't be an importer, put up tariffs against imports, try to accumulate wealth. He said some kind things about gold. These are all things that indicate that he would favor a weaker dollar to promote exports, because that's what mercantilists want to do. They want to promote exports and build up reserves and build up surpluses. So he's also been fairly strident in attacking Janet Yellen. Now, I'm one of the most persistent critics of Janet Yellen around, but I'm not running for president either. So, you can read about it in my books or on podcasts or hear about it on podcasts like this. But there is some serious concern that he might actually try to push her out. Now, the Fed is independent. The Fed chairman has a 4-year term. Janet Yellen's term is not up until January 2018. Legally, there's nothing Trump can do to get rid of her, but he can make her life really uncomfortable. He can make her the object of critical speeches and, if not ridicule, and sort of, push her into an early resignation, and that's likely to be very negative for the dollar. So I don't want to put a stake in the ground. I don't mind giving definitive forecasts if I have a good basis for it, and that's how I feel about the Fed hiking in December. I feel that that's a very solid analysis, and I'm willing to be fairly definitive about that. I don't want to say that the dollar will go down if Trump wins, but I suspect that that's a likely scenario. I feel much more comfortable saying the stock market will go down. Now, the interesting thing about that, I could see the stock market going down 10% almost overnight if Trump wins, but then consolidating and coming back, because once that immediate repricing, once that shock effect is over, people might say, wait a second, this guy is talking about cutting taxes and infrastructure spending and making America great again and renegotiating trade deals. He might actually be good for the economy in certain ways, and then you might see stocks start to come back. So I don't want to get too attenuated in the forecast. So I think the immediate reaction is stocks go down, not because they're going down 30 or 40%, but just because they have to reprice for an unexpected outcome. But yeah, I think you might see the dollar go down too, and definitely the dollar price of gold should go up. I think there's very little doubt about that.
So I found that very interesting what you just said there, Jim, about Trump and him having a mercantilist view. And again, we're not really talking about this for purposes of the political discussion, but more so how the politics affect the financial aspect and the markets aspect of things. But Trump has repeatedly accused China of devaluing their currency, which I really find interesting because the U.S. is constantly devaluing its currency, and so is virtually every other central bank in the world. So my question about that, and this is my question to you, Jim, is do you think that he's doing that as a posturing sort of thing in preparation for future negotiations with China, or do you think he really just doesn't understand what's happening there?
Well, he might have an intuitive understanding. I don't think look, Trump's a businessman and a builder and an entrepreneur, and he's had some success at that, some failure as well. I think that's all pretty well documented. He's made a few turns on what Boethius is called the Wheel of Fortune. But having said that, I don't think he's an economic or monetary expert by any stretch. He does seem open to getting advice. He might just have an intuitive feel that we need a more sound form of money. By the way, I've heard the same thing from Ben Bernanke and John Lipsky. I spoke to Ben Bernanke about this, and John Lipsky, not as well known, but former head of the IMF, and I spoke to him, and they both told me that they view the international monetary system as incoherent. That was their word, not my word. That's a fancy way of saying, this is getting wobbly. There's no anchor. Just look at what's happened in currency markets in the last year and a half, Alex. We don't even have to go back 20 or 30 years. Just go back to the summer of 2015. So you had a shock devaluation of the Chinese 2015. Then you had this complete shock revaluation, upward valuation of the Swiss franc, where the euro fell against the Swiss franc last January by 20% in 1 hour. Then you had the Brexit, where sterling fell 14% against the dollar in about 2 hours. You had the flash crash in sterling last Friday, not even a week ago, where it fell about 8% in 7 minutes. Now think about it. The yuan, the dollar, sterling, these are all reserve currencies. These are the first, second, fourth or fifth largest economies in the world. And money is supposed to be a stable store of value, and yet it's bouncing around, 3, 8, 7, 14, 20% in a matter of hours. That's not money. That's not stability. That's a very unstable system. And I think that's what Bernanke and Lipsky were saying. In fact, I'm sure of it, that they're saying, we got rid of fixed exchange rates. We got rid of the gold standard. We thought we had it all figured out with these floating exchange rates. Markets could adjust. You wouldn't have to go through these devaluation struggles anymore. Just let the market do the work. The problem is that without an anchor, there's more involved than just the market. You can have manipulation. You can have speculators. You can have leverage, hedge funds, exogenous shocks. There are a lot of factors all of a sudden in a world of floating exchange rates that may be transitory, but knock currencies for a loop. And so you've got this very, very unstable system, and it may just be the case that Trump has an intuition that we need an anchor.
Yeah, it's really incredible as far as the lack of stability in currency values. And I think it all comes back to this whole thing that we've talked about before, is that there's just no longer any anchor.
Yeah, I mean, as you know, the foreign exchange market on a normal day, we haven't had very many normal days lately, but normally it trades at the fifth decimal place. You know, you don't see percentage point moves in currencies. You see, 3/10,000ths of 1%. That's how currencies normally trade. And yet all of a sudden we're seeing full percentage points, multiple percentage points in a single day or even a couple hours. So these are earthquake-style moves.
All right, so we only have a few minutes left. There are still a ton of questions here, and we thank everyone for submitting your questions. We are always appreciative of that, and we do our best to try and get them all answered in the time allotted. We're going to take one more that seems to be coming up quite a bit. As I mentioned a little while ago, the people that we've been talking to are constantly voicing concerns over protecting their buying power. And one of the questions that have come in, this is from John B. He wants to know, can you comment a little bit or provide some insight as to the buying power of gold?
Well, the buying power of gold is measured in other currencies as long as things are priced in those other currencies. Now, I actually foresee a day when things will be priced in gold. You'll go to get a new car, and instead of saying, the car's $25,000 or $30,000 or whatever, they'll say, well, I'll take 25 ounces of gold. And you might be able to hand over 25 ounces of gold or some kind of gold warehouse receipt or something. So that would be priced in gold. But that's not the world we live in today. We live in a world where things are priced in some currency, dollars. Obviously, I'll be going to Australia in about 10 days, and I'll be spending Australian dollars. And I'll go to Ireland and spend euros. So the purchase of gold is really, how much of that other currency can you convert the gold into if you had to go buy something? And that's where, gold performs a lot of functions, but as a form of money, it tends to be the one that doesn't get devalued. It tends to be the one that will preserve purchasing power. So a simple example, if a car today, I'll just pick numbers out of a hat, if a car today is $20,000 and that comes to, that would be about 15 ounces of gold, give or take, and we have a bout of inflation and the same car goes to $40,000, I would expect it would still only cost you 15 ounces of gold. In other words, the gold would be worth twice as much. The gold would be worth $2,500 an ounce in a world where there's no way that the price of everything else is going to double and the price of gold is going to stay the same measured in dollars. Obviously, the price of gold is going to double as an answer to the inflation at least. If not, it'll go up more in anticipation of more inflation or loss of confidence in paper money or geopolitical shocks or some other factor. So that's what gold does. It preserves your purchasing power.
Yep, I agree wholeheartedly. It's something we've been talking to people about for many years. So with that about wraps up our time. Jim, I want to thank you, as always, for incredible insight and discussion here today. For those of you who are listening in, Jim's got a new book coming out, The Road to Ruin. I believe it's still it's available pre-order on Amazon right now. Is that right, Jim?
Right. Correct.
Okay,
Thank you.
Please go check that out. And with that, I am going to turn it over to you, John.
Well, thank you, Alex, and thanks for your insightful contributions today. And yes, from me also, thank you, Jim Rickards. It's always a pleasure and an education having you with us. And most of all, thank you to our listeners for spending time with us today. Let me encourage you to follow Jim on Twitter. His handle is @JamesG.Rickards. So goodbye for now, and we look forward to joining you again soon.
You have been listening to The Gold Chronicles with Jim Rickards and Alex Stanzik, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.